Yo, want to raise big capital, invest in multiple deals at once, and scale like the pros without becoming a broker-dealer, an RIA, or violating SEC rules and going to jail? Then you need to understand the fund-to-funds model. This strategy is how some of the most successful capital raisers go from small syndications and small, tiny funds to managing hundreds of millions of dollars without running the actual properties themselves. But here's the catch. If you don't structure it correctly, you could be in violation of major securities laws, including the Investment Company Act of 1940 and the Investment Advisors Act of 1940. Over the last 13 years, I've built over 700 funds as a securities attorney and capital raiser, representing over $9 billion in transactions and over $3 billion in capital raised. Today, I'm giving you the exact playbook to legally pool capital into a fund of funds, avoid common SEC mistakes, and to scale fast. All right, first things first, what is a fund of funds? All right, let's break it down. What is it? What the hell is a fund of fund? Simply put, it's a capital raising vehicle where you raise money from investors and then invest that money into other people's deals, usually large syndications, real estate funds, or private equity deals. Instead of being the operator, the lead sponsor, dealing with tennis toilets and trash, or managing construction projects, you're the capital aggregator, the independent capital aggregator, as we like to say. You bring the money to the table, negotiate better terms with sponsors, and take a cut for structuring, administering, operating the fund itself. Now, before we get started into structuring, you really need to understand two federal laws that come into play the moment you start a fund of fund. The Investment Company Act of 1940 and the Investment Advisors Act of 1940. These two pieces of law exist specifically to regulate investment funds like yours. If you ignore them, you could be forced to register with the SEC, face massive compliance costs, or even get shut down. All right, first, the Investment Company Act of 1940. This law was created to regulate investment funds pooling capital into other securities. Exactly what we're talking about here, the fund of funds. So if your fund of funds is structured incorrectly, you could be classified as an investment company under the act, meaning you'd have to register with the SEC, which is expensive, it's time consuming, and it's totally unnecessary if you structure things right. You do not want to do this. You do not want to be considered an investment company. All right, next, the Investment Advisors Act of 1940. This law applies to anyone managing money on behalf of investors and giving investment advice. Think of it like a financial advisor, because that's what it is. If you're not careful, your fund of funds could classify you as an investment advisor, requiring you to register and comply with additional regulations under FINRA and the SEC. So what's the solution? Well, as always, there are exemptions that keep you outside of these laws, but you have to structure your fund properly. Let's go into how to do that. All right, I call this the Raise Law Fund of Funds Playbook. Here's how you set up a legal, SEC-compliant fund of funds without triggering the Investment Company Act or the Investment Advisors Act. This is the Raise Law Fund of Funds Playbook. Number one, use the right exemption to avoid registering as an investment company. All right, let's break these down one by one. The most important one in this instance is what's called a 3C1 exemption for private funds for up to 100 investors. This is used most commonly for fund of funds, and it allows you to have up to 100 beneficial owners, sometimes 250 for qualified venture capital funds, but for this purpose, we're talking about 100 beneficial owners. And all investors must either be accredited if it's a 506C or a mix of accredited and up to 35 sophisticated investors if it's a 506B. But remember, you're actually one of the 100 beneficial investors, so you're actually limited to 99, so you'll sometimes hear this called the 99 investor rule. All right, next, the the 3C5 exemption, which is a real estate asset-based exemption, and this can be a difficult one to navigate. It's used when a fund directly holds or originates real estate assets or loans, such as a mortgage REITs or things like that. And it's not necessarily appropriate for fund of funds unless you have a mix of fund of funds and also actually the operating partner on some deals where you're joint venturing and own the real estate directly. It doesn't apply if your fund is investing solely passively as a fund of funds into other operators, syndications, and funds, and it's often misunderstood and widely misused by people trying to make fund of fund structure work outside of securities laws. And you'll just really have to be careful here because you have to have the right mix of real estate assets versus fund of funds or passive assets, and around 80% direct and indirect real estate assets held at a given time. And last, I wanted to briefly mention a 3C7 exemption, which is for qualified purchasers only, which is really difficult for folks. It does allow unlimited capital and investor count, but all investors must be qualified purchasers, which means $5 million plus in investments, not just net worth. So that's really difficult to raise from that investor pool. It's a more advanced exemption for institutional funds, family offices, and folks like that. So it requires a lot tighter compliance controls, usually not applicable for early stage ICAs or small fund of funds. All right, step number 2, structure your role to avoid becoming what's called an investment advisor. To avoid registering as an investment advisor, your fund of funds must offer one investment option only, and you can't advise investors on different deals. It's almost like you're a conduit into the actual operational lead sponsored deal. Your fund must operate as kind of a pass-through entity, investing in these pre-selected deals rather than giving individual recommendations on particular sponsors or deals, and the investors actually are making that decision for themselves rather than you advising. Alternatively, you can file for what's called a truncated form ADV and become an ERA, and that's at the state level. So you're going to want to look at each individual state to see what that requires. Sometimes that's a great option, right? You can actually advise people once you make that filing and it gets approved by FINRA and your state government. But the problem there is it does take some time and it does vary quite a bit. And sometimes the limitations put on your investor pool makes it impossible to use that as a possible route, because for instance, instead of just accredited investors, you might have to raise capital from qualified clients or qualified purchasers, making that investment hurdle really, really high. Or perhaps you actually have to be a registered investment advisor in your particular state. It really just depends state to state, and you'll have to do a particular analysis in the state in which you sit, not the state in which the LLC that you operate under is organized. That's a key. Step 3, and this might be step number 1, but we need to do all these things kind of simultaneously. But use the right fund structure. Set up an LLC or an LP structured as a 506B or a 506C offering under Regulation D, because we are still needing to comply with the 1930s Acts. You must have a PPM, an operating agreement, a subscription agreement in place. And companies like TribeVest offers a turnkey, done-for-you solution that ensures your fund of funds is set up properly from day one. And here at Raise Law, we can also set those up for you, the ones that are more complex and might need a little bit more hand-holding and guidance. All right, let's go into the biggest mistakes fund managers tend to make when setting up their fund of funds. So here's what not to do if you want to keep your fund of fund legal and scalable so you can build a big business. Mistake number 1, accepting too many non-accredited investors. If you raise under 3C1, you're limited to 99 investors. If you take more than 35 non-accredited investors, you're also in violation of your 506B exemption. Make sure you keep track of your investors, have the paper trail ready to go. Mistake number 2, acting like a financial advisor. If you're giving investment advice, you could trigger investment advisor registration. The solution is to stick to pre-selected investments within your fund where your investors are actually making those decisions for themselves. They're either in or they're out. All right, mistake number 3, using the wrong exemption. Again, 3C1 for smaller private funds, 100 beneficial owners. 3C7 for institutional capital raisers where your minimum investments are very, very high and the people that are investing with you have an ultra high net worth. All right, you pick the wrong one and you can block yourself from raising capital legally and get yourself in a lot of trouble. A fund of funds is a powerful way to scale, but only if you structure it the right way. If you screw this up now, you could face SEC violations, exemptions blown, investor lawsuits, and you might even get shut down before you even start. That's why at TribeVest, we do offer done-for-you, end-to-end fund-to-fund setup and administration so you can focus on raising capital and relationships and scaling your business. And if you need a deeper legal structuring and knowledge and have tons of questions to ask, and this is your first time and you want to build a complex fund of funds with lots of different facets, Raise Law has you covered too. Hit the link below, schedule a call, and let's build your fund of funds the right way. No SEC headaches, just fully funded deals. All right, let's go.